Welcome back to Stock Kong Invest and Analysis, where we look at the market and break down the opportunities.
Pause. Palantir's growth shifted from new contracts to expansion-led economics, supported by net dollar retention consistently above 130%. Adjusted operating margins expanded from low teens in 2023 to over 40% recently, alongside revenue growth exceeding 50%. Deployment efficiency improved materially, with software installation time falling fivefold since 2019, and AIP bootcamps compressing time to value. Shorter sales cycles, faster revenue conversion, and sales and marketing spend growing slower than revenue mechanically improve CAC payback. High revenue visibility from approximately 134% total NDR and government contracts spanning 5 to 10 years reduces execution risk. Investment thesis. Since my last coverage, Palantir Technologies Inc., PLTR, has been relatively quiet in the market with strong fundamentals, and it seems as if the market is now ready for earnings confirmation before the next leg up. The big question in the market for PLTR now is whether the valuation has become too rich. The real question is not whether the valuation looks rich, but whether the business today resembles the one investors thought they were buying 2 years ago, because the economics underneath it no longer do. The core transformation behind the headlines. What strikes me most is that the nature of Palantir's expansion has evolved significantly. In earlier stages, expansion was very much a result of new business contracts, lengthy pilot projects, and manual deployment phases. While expansion was certainly happening, there was a cost associated with that expansion. Now, expansion is more and more a result of expanding with existing customers. It represents a complete difference in economic dynamics for the company. NDR rates over 130% in core segments indicate something significant. Customers are not just retaining contracts, they are increasingly dependent upon them. This is not the behavior of customers merely testing a product. It is the behavior of organizations rebuilding their workflows around it. Once that is accomplished, pricing leverage and cash flow durability become almost automatic. Another area of importance is the growth of margins and the growth of the business at the same time. In the world of business software, these two things tend to go in opposite directions. You invest in order to grow, and then you reap the margins later. Palantir has done both at the same time. This is an indication that the product has gotten to a stage where the revenue growth does not necessarily entail additional costs. The trend in margins is also looked at separately. The key is how the margin has been generated. The margin growth that Palantir has delivered is not via cost-cutting or margin engineering. The key is the leverage of scale. The operating margins on an adjusted basis have moved from the low teens in 2023 to 40% plus in the recent periods, while the revenue growth has also moved above 50% at the same time. This is a rare phenomenon. With more and more processes being shifted to AIP and ontology-based systems, the requirement for custom engineering will reduce. The software will replace services. Every marginal dollar of revenue will have a greater contribution margin than the previous marginal dollar of revenue. This is what is referred to as operating leverage, which is likely to be sustained rather than reversed. It is essential that this trend turns out to be sustainable. If margins were increasing as a result of delayed investment, I would be much more hesitant. Rather, I see that the company's period of high investment is finally bearing fruit. This does not mean that margins will continue to rise, but that the present level is not the highest. Rethinking Palantir's go-to-market. Palantir's go-to-market strategy has been viewed for years as a weakness in the company's structure, rather than an intentional strategy. The presence of high-touch deployments and engineers forward-deployed in client companies indicated that the company's product couldn't be scaled without human assistance, which is true at a certain point in a company's evolution, but not applicable in the case of the company that Palantir is today. What changed is not the embedded deployment itself, but its efficiency curve. As disclosed in Palantir's S1, the time required to install its software decreased more than fivefold from Q2 2019 to an average of 14 days by Q2 2020. Since then, AIP bootcamps have further compressed deployment, enabling work that once took months to be achieved in days, and often translating into paid contracts within the same quarter. Palantir does not disclose CAC directly, but it discloses the drivers that determine it: a shorter sales cycle, quicker conversion from engagement to revenue, growth from expansion with NDR rates over 130%, and sales and marketing expenses growing slower than revenue improve CAC payback in a mechanical way. The same can be said for revenue visibility. With total NDR at approximately 134%, exceptionally strong expansion in the U.S. commercial segment, and government contracts spanning 5 to 10 years, Palantir materially reduces near-term execution risk. In a high multiple regime, at asymmetry matters.
Hey viewers, don't forget to like, subscribe, and add our channel to your favorites. We will continue to provide you with more insightful stock analysis.